All right, so in Chapter 20 we're going to discuss international corporate finance, get a little bit of oversight into currencies. The key concepts and skills, looking at exchange rates, differentiating between spot and forward rates, specifying the distinction between purchasing power parity and interest rate parity, and the implications for changes in exchange rates. We'll look at the basics of international capital budgeting and look at some of the risk factors in international investing. The terminology, just some terms here. An American Depository Receipt, ADR, is a security issued in the U.S. to represent shares of a foreign stock. Cross rate is the exchange rate between two foreign currencies. So, for example, the exchange rate between British pounds and Japanese yen. The euro is the single currency of the European Monetary Union, which was adopted by member states on January 1st, 1999. Just a little color here. There's a great deal of discussion right now about whether the European Union will survive, given the problems with Greece and Spain and Ireland and some of the other euro countries. Eurobonds are bonds denominated in a particular currency, usually the issuer's home currency, and issued simultaneously in the bond markets of several countries. So, for example, if IBM issues bonds denominated in US dollars and issues them in, say, Germany, that would be a Eurobond. Euro currency is money deposited in a financial center outside the home country. So euro dollars, for example, are dollar deposits held outside the U.S. Euro yen would be yen-denominated deposits held outside the Japan. Foreign bonds are bonds issued in another country using another nation's capital markets by a foreign borrower. So again, if IBM were to issue bonds in Germany denominated in German currency, those would not be euro bonds, those would be foreign bonds. Gilts is a name for British and Irish government securities, and LIBOR, which stands for London Interbank Offer Rate, is the rate most international banks charge one another for loans of euro dollars overnight in the London market. Foreign exchange markets and exchange rates, without a doubt, the foreign exchange market is the world's largest financial market. In this market, one country's currency is traded for another, and the most commonly traded currencies, the dollar, the British pound, the Japanese yen, and the euro. Forex market participants, we can basically divide the Forex into wholesale and retail markets. In terms of participants, about 700 banks worldwide stand ready to make a market in foreign exchange. And then about 20% of the wholesale market is made up of non-bank dealers. And then we can break groups into brokers or specialists. Brokers are people who match buyers and sellers, buy orders and sell orders, but they don't actually carry an inventory, whereas FX specialists actually carry an inventory. Market participants include international banks, their customers, non-bank dealers, foreign exchange brokers, and central banks. Exchange rate is the price of one country's currency in terms of another's currency. Most currency is quoted in terms of dollars. So here's a quote. The euro, we have 1.29167 and 0.77419. The first number, the 1.29167, is how many US dollars it takes to buy 1 euro. And the second number, 0.77419, is how many euros it takes to buy a dollar, and those two numbers are reciprocals of each other. Suppose, for example, that you have $10,000, and based on the rates in figure 20.1, and that figure may change, but how many Swiss francs can you buy? Well, the exchange rate is, if the exchange rate is 1.1181 francs per dollar, then $10,000 will buy you 11,181 francs. Now suppose you're visiting Bombay, India, and you want to buy a souvenir and it costs 1,000 Indian rupees. How much would that cost in US dollars? Well, if the exchange rate is 45.85 rupees per dollar, then the cost would be, as you can see, $21.81. Cross rates. We use this term SDM parentheses 0 to represent the spot rate. This is the spot rate of Deutschmarks for dollars at time 0. And it looks like a $1 will buy us 2 Deutschmarks in the spot market. And similarly, $1 will buy us 100 yen in the spot market. So we can from that infer what the Deutschmark to yen cross rate would be. And the big thing here is to keep track of units. So Deutschmark divided by yen is dollars divided by yen times Deutschmark divided by dollars. So we take the $1 divided by 100 yen times 2 Deutschmark divided by $1. The dollars cancel, and we get 2 Deutschmark per 100 yen, or 1 Deutschmark per 50 yen. So the spot rate between Deutschmarks and yen would be 0.02, or 1 Deutschmark per 50 yen. This brings us to a triangular arbitrage now. Suppose that we observe these banks posting these exchange rates. So we have Barclays willing to exchange for $1, 120 yen. Credit Lyonnais willing to change £1 for $1.50, and Credit Agricole willing to change, I guess that's yuan, that's pounds, I'm sorry, willing to change $1.50 for a pound, and Credit Agricole willing to change 85 yuan for 1 pound. First, we can calculate the implied cross rates to see if an arbitrage exists. So let's do that. First of all, the rate between pounds and yen implied, if we go from 1.5 pounds per dollar to $1 for 120 yen, that implies that we can get 1 pound for 80 yen. Now Credit Agricole is willing to sell us a pound for 85. So there does appear to be an arbitrage opportunity, and the question is, how can we make money? Well, it's fairly easy, as they say, as easy as 1, 2, 3. We first sell our dollars for pounds. We then convert our pounds into yen, and then we convert yen back into dollars, and amazingly, in the process, we create money. So let's look at this. Let's take $100,000 and trade them at $1.50 per pound for pounds. So for $100,000, we will receive 150,000 pounds. We'll sell our 150,000 pounds at 85 yen per pound, and we'll receive 12,750,000 yen. We then convert the 12,750 yen back into dollars at the rate of 120, and we end up back with $106,250. So we made a round trip. We started with 100,000. We did nothing but convert currencies, and in the end we end up with $6,250 more than when we started. Let's look at some types of transactions. Two types. First, spot trade. Spot trade is the exchange of currency immediately, and the spot rate is the exchange rate for an immediate trade. So right now I want to trade dollars for yen. A forward trade is an agreement today to exchange currency at some future date and some specified price, called the forward contract. So I can contract today to take Japanese yen a year from now and convert them into dollars, and I can lock in the rate of exchange. The forward rate is the exchange rate specified in the forward contract. If the forward rate is higher than the spot rate, then the foreign currency is selling at a premium when quoted in dollar equivalents. And if the forward rate is lower than the spot rate, then the foreign currency is selling at a discount. Now let's talk about absolute purchasing power parity. The price of an item is the same regardless, that is, if we have absolute purchasing power parity, the price of an item is the same regardless of the currency used to purchase it. So the requirements for absolute purchasing power parity to hold are that transactions costs are zero, and of course they seldom are, that there are no barriers to trade, no taxes, no tariffs, etc., and normally there are barriers, and no differences in the commodities between the locations. So wheat is wheat, corn is corn, and that may not be quite true either. For most goods, absolute purchasing power parity rarely holds in practice, for the obvious reasons that those above requirements don't usually hold. Then we talk about relative purchasing power parity, and the big issue here is inflation, and we're going to denote inflation by the letter H. So relative purchasing power parity provides information about what causes changes in exchange rates. The basic result is that exchange rates depend on relative inflation between countries. So the exchange rate at some point in the future, at some time t, is equal to the spot rate times 1, we multiply by this thing raised to the t power, and the thing is 1 plus the difference between the foreign inflation rate and the U.S. inflation rate. Because absolute purchasing power parity doesn't hold for many goods, we'll focus on relative purchasing power parity. So here's an example. Let's suppose that the Canadian spot exchange rate is 1.18 Canadian dollars per U.S. dollar. U.S. inflation is expected to be 3% and Canadian inflation is expected to be 2%. Question is, do you expect the U.S. dollar to appreciate or depreciate relative to the Canadian dollar? Well, if inflation is higher in the U.S., we would expect the U.S. dollar to depreciate relative to the Canadian dollar. Just hang on that point for a minute because I want you to think about something. Which country has the higher inflation rate, the U.S. or China? And the answer now, and I'm making this recording in January of 2011, the answer right now is that China has significantly higher inflation, and therefore we would expect the the Chinese currency to depreciate relative to the dollar. In fact, the Chinese currency is not depreciating relative to the dollar, and the main reason for that is that the Chinese have pegged their currency to the dollar and refuse to let the currency adjust. Anyway, back to our example. Inflation is higher in the U.S., so we would expect the U.S. dollar to depreciate relative to the Canadian dollar, and the expected exchange rate in 1 year would be the spot rate, 1.18, multiplied by 1 plus, we'll take the Canadian rate, 0.02, minus the U.S. rate, 0.03, and we see that the spot rate will go from 1.18 to 1.16. Which suggests that the U.S. dollar will depreciate relative to the Canadian dollar. Now, interest rate parity is another interesting idea. Interest rate parity is an arbitrage condition, and by arbitrage we mean that there's some sort of imbalance, and the imbalance provides us an opportunity to trade and make money. Generally, we would argue that arbitrage conditions will go away or can't exist because people will trade on them until they disappear. If interest rate parity didn't hold, then it would be possible for an astute trader to make unlimited amounts of money exploiting this arbitrage opportunity. And since we don't observe persistent arbitrage conditions, we can safely assume that interest rate parity holds. Let's look at an example. Suppose that you have $100,000 to invest for 1 year. Well, you can either invest in the U.S. at a rate of I, and you'll have a future value of 100,000 times 1 plus I, or you can trade your dollars for yen at the spot rate, invest in Japan at their interest rate, which is denoted by I sub yuan, and hedge your exchange rate risk by selling a future contract so that essentially you're able to convert the future value of the investment in Japan back into dollars. So the 100,000 divided by S converts the dollars into yuan. When we multiply by 1 plus I sub yuan, we get the future value of the investment, and when we multiply by F, that brings this thing back to dollars. We can do a little algebra. We can set this equation up that the forward rate divided by the spot rate times 1 plus the interest rate in Japan is equal to 1 plus the interest rate in dollars. Sometimes we rearrange that and we say the forward rate is to the spot rate as 1 plus the interest rate in dollars is to 1 plus the interest rate in yen. And if we subtract 1 from both sides of that equation and do a little bit of assumption, namely that the product of the interest rate in the U.S. and the interest rate in Japan is essentially zero, we get interest rate parity sometimes approximated as the rate in dollars minus the rate in yen is equal to the forward minus the spot rate. In other words, the change in rates divided by the spot rate, or the percentage change in the spot rate. Interest rate parity and covered interest arbitrage. If interest rate parity failed to hold, an arbitrage opportunity would exist. It's easiest to see this in the form of an example. So consider the following data. Take a look at it, and let's go to the next chart. A trader with $1,000 to invest could invest in the U.S. In 1 year, his investment would earn 7.1% and be worth $1,071. Alternatively, the trader could convert his $1,000 into 800 pounds. And the prevailing rate is 1.25 as the table suggested. We could then invest the 800 pounds at the British rate of 11.56 for 1 year, and we would end up with 892.48 pounds. We then translate those 892.48 pounds back into U.S. dollars using the forward rate. So we would have arranged this today essentially, but we would do it when the investment matures at a rate of $1.20 per pound, and the 892.48 pounds will work back to exactly $1,071. So essentially, interest rate parity says that whether we invest directly in the U.S. or we go through the route of investing in England and then converting back into dollars, we will get the same result. And if that were not true, you would find a way to make money on that trade. Let's look at some pictures of this. So a trader with $1,000 to invest can invest in the U.S. In 1 year, his investment will be worth $1,071. Or we get this kind of lovely thing. You first take the $1,000 at an exchange rate of $1.25 per pound, and you get 800 pounds. You then invest the 800 pounds at the British rate of 11.56, and in 1 year you will have 892.48 pounds, which you now convert back at a rate of $1.20 per pound back into U.S. dollars, and you end up with that 1,071. So you end up with the same results. Reasons for deviations from interest rate parity. Well, transactions costs. The interest rate available to an arbitrageur from borrowing, denoted by IB, may exceed the rate he can lend at, noted by IL. And there may also be a bid-ask spread to overcome. So the future exchange rate, which we take as a bid, and the spot rate, which we take as an ask, would be less than the theoretical ratio. So that ratio, the two ratios would not be equal, and therefore we would end up with an inequality. Third reason for deviation is capital controls. Governments sometimes restrict imports and exports of money through taxes or outright bans. International Fisher effect. Now this is an approximation. The exact relationship would involve some division, but combining purchasing power parity and interest rate parity, we get the International Fisher effect, which says that the rate in the U.S. minus the inflation rate in the U.S. is equal to the interest rate in the foreign country minus the inflation rate in the foreign country. Basically what that tells us is that the real rate of return must be constant across countries. If that were not true, then investors will move their money to the country with the higher real rate of return. So let's talk about international capital budgeting, because this course is really about capital budgeting. There are two approaches, the home currency approach and the foreign currency approach. Oops. In the home currency approach, we first estimate the cash flows in terms of the foreign currency. We then estimate the future exchange rates using interest rate parity. We convert the cash flows to dollars, and we discount using the domestic required rate of return. Okay. Second is the foreign currency approach. And in the foreign currency approach, we first estimate the cash flows in the foreign currency. Now, I believe, if we go back to the home currency approach, I believe there's an error in that slide. We first would estimate the cash flows in the local or domestic currency, not the foreign currency. But anyway, in the foreign currency approach, we estimate cash flows in the foreign currency. We then use the future exchange rate, the interest rate future exchange rate, to convert domestic required returns to foreign required returns. We then discount using the foreign required return, and we convert the net present value to dollars using the spot rate. Okay, so here's a home currency approach. Your company is looking at a project in Mexico. The project is going to cost 9 million pesos. The cash flows are expected to be 2.25 million pesos per year for 5 years. The current spot exchange rate is 9.08 pesos per dollar. The risk-free rate in the U.S. is 4%, and the risk-free rate in Mexico is 8%. Just looking at those two rates, it suggests that the inflation rate in Mexico is 4% higher than the inflation rate in the U.S. because the real rates have to be the same. And the dollar required return is 15%. And the question is, should the company make the investment? And let's look at the spreadsheet. So we start out with time zero. We invest 9 million pesos, and the exchange rate is 9.08, and so the cash flow converts into $991,189. Then we calculate the exchange rate. Now what we do here is we use the Fisher equation, and so for each exchange rate we multiply the spot rate multiplied by 1 plus the difference in the two inflation rates, which would be 4%, raised to the power. So this would be the spot rate, 9.08 times 1.04 to the first power. This would be 1.04 to the second, 1.04 to the third, and so on. This gives us a decreasing set of cash flows. So the cash flows in pesos are constant, but because of Mexican inflation, the cash flows in terms of U.S. dollars are decreasing. When we take the present value of these cash flows at the required return of 15%, we get a net present value of $243,553.24 negative. And so this project does not look like a good project. Now let's look at the foreign currency approach. We use and we're going to get a slightly different answer because the Fisher effect is an approximation. It's doing some things that I don't want to get into here. But we'll use the same information as the previous example. We'll estimate the net present value, this time using the foreign currency. So the Mexican inflation rate from the International Fisher effect, as we noted, is 4%, actually 4% higher than the U.S. rate. So the required return, if it's 15% in the U.S., it will be 19% in Mexico. The present value of the future cash flows, and this time we'll use Mexican cash flows of $2,250,000, I think, whatever it was. The present value of those future cash flows is 6,879,679 pesos. Subtract the 9 million peso cost, and we get a net present value of negative 2,120,321 pesos. And convert that using the spot rate back into dollars, and we still get a loss of 233,516. Notice it's slightly different. It's slightly different. And that's because this Fisher effect here is really an approximation. We're using an approximation rather than an exact relationship. Let's talk about exchange rate risk. Short-run exposures to exchange rates, risk from day-to-day fluctuations in exchange rates, and the fact that companies have contracts to buy and sell goods in the short run at fixed prices. How do we manage this risk? Well, we can enter into forward agreements to guarantee the exchange rate, or we can use foreign currency options. Now, don't get foreign currency exchange rates confused with foreign currency options. This would be an option on a foreign currency to lock in an exchange rate in such a way that if the exchange rate moves against you, you benefit. But if they, you're protected if they move against you, but you benefit if the rates move in your favor. Long-run exposure. Well, long-run fluctuations come from many unanticipated changes, or can, in many ways, from relative economic conditions. Could be due to changes in labor markets or governments. Much more difficult to hedge against long-run exposure. One thing you can do is try to match long-run inflows and outflows in the currency. You can also try borrowing in the foreign country. That may mitigate some of the problems. Now, translation exposure. If you're a U.S. company, then your income from foreign operations must be translated back to U.S. dollars for accounting purposes, even if the foreign currency is not actually converted back into dollars. So you have to state it in dollars. If gains and losses from this translation flowed through directly to the income statement, there would be significant volatility in earnings per share. So what the accounting community has done, current accounting regulations require that all cash flows be converted at the prevailing exchange rates, and currency gains and losses are accumulated in a special account within the equity section. So they don't flow through the income statement through retained earnings into the equity section. They go directly into the equity section. That takes the volatility out of the income statement. Managing exchange rate risks. Well, large multinational firms may need to manage the exchange rate risk associated with a number of different countries, different currencies. The firm needs to consider its net exposure to currency risk instead of just looking at each currency separately. Trying to hedge individual currencies could be expensive and may actually increase exposure. And you can imagine that a very large multinational company doing business all over the world, this would be a very, very complicated process, or could be. Political risks, changes in value in the currency due to political actions in the foreign country. In fact, due to actions in our country. If our country were to say, for example, we don't like what China is doing, so we're going to slap a tariff on Chinese goods, and the Chinese retaliated, and we started a trading war. So changes in value due to political actions in countries. Investment in countries that have unstable governments should require higher returns, simply because they have higher risk. The extent of political risk depends on the nature of the business. If this is a business that pretty much is unique to you and it depends on your operations and you depend on it, then you're less vulnerable to actions by others and it's less valuable to others. On the other hand, natural resource development can be very valuable to others, especially if much of the groundwork in developing the resource has already been done. So think of the multinational oil companies going down into countries like, for instance, Venezuela, and then Cesar Chavez decides to nationalize the oil companies. One way to reduce at least the interest rate risk or the currency risk is to use local financing. Okay, so a quick quiz, and you can kind of go through these in your mind. If they don't stick, I would suggest you read the chapter or go back through the slides. What does an exchange rate tell us? What is triangle arbitrage? We went through an example of that. Remember, with the dollars and the pounds and the yen. What are absolute purchasing power parity and relative purchasing power parity? What are covered interest arbitrage and interest rate parity? And uncovered interest parity and the international Fisher effect? What are the two methods for international capital budgeting? What's the difference between short-run interest rate exposure and long-run interest rate exposure? And how can you hedge each type? And what is political risk, and what types of businesses face the greatest risk? All right, that pretty much concludes our slide, our chapter.